Well, hello, everyone who may be looking at this video today. My name is Guido Vanderhoven. I retired from NC State University about 6 years ago, but have continued to work in the area of farm management and taxation, at least at that intersection, and was asked to present this particular webinar that we have today, the title of which, as you can see on the screen, is Tax Definitions. And then there's a parenthetical that I added, Safe Harbors of a Farmer. And I think it's a little bit more of an accurate statement to look at it from a safe harbor standpoint. And we'll explore that as we move into the webinar. This webinar is being presented by Rural Tax Education, which is a website hosted by Utah State University, as you can see on the slide. And for many years, I was part of the National Farm Income Tax Committee that worked on various informational materials, as you can see listed there on the slide as well. And the QR code for those that might want to use it to go directly to ruraltax.org to access some of these fact sheets or broader discussions. They are available there for one to use and to access. This work that Rural Tax does is been funded by an agreement with the United States Department of Agriculture, as you can see listed there, and that we are working to give the best educational information and is, as you can see in the disclaimer, the programs and activities of our land-grant universities, Utah State being one, NC State being another, Oklahoma State being a third, as just examples. They are there and do not discriminate based on the race, color, religion, sex, national origin, age, or genetic information, etc., for in state or federal law. What we're going to look at today, and this is kind of the agenda. The title again is the Tax Definitions or Safe Harbors of a Farmer that we are presenting through ruraltax.org. And what I want to begin with is defining farm and farming and do a quick baseline, and then looking a little more deeply and looking at defining a farm or rancher. Again, a quick baseline looking at that. And then we're going to delve into the Internal Revenue Code, which is abbreviated there in that parenthetical as IRC, for the definitions, or maybe more accurately, safe harbors for farmers. And these safe harbors may be thresholds of income that need to be reached, and we will need to be certain to understand what we're talking about relative to income. And I hope also that some of the examples that I've put together will be useful to folks who are listening or who will listen to this presentation sometime after today. Broadly, we want to think about the farm, and we see there's a citation there at the lower left on this particular slide. And this is one of those definitions specifically to Code Section 2032 Cap A, which is for special use valuation in the case of an estate. But it does provide us some insight to the thinking not only of Congress, but also of Treasury and the IRS as to what they look at as to what a farm is. Firstly, a farm is a business, and it does come with a profit motive. So they are trying to make a living and engaging in that business of producing either livestock, dairy, poultry, fish, fur, fruit, and truck farms. And as you can also see there, it includes plantations, and we could think about timber plantations, ranches, ranges, orchards, and groves. So it's very broad in this definition of what a farm is, and there are a couple of little bullet points there below that definition, and that would include crop farms. So that would be possibly be if you're thinking about corn, soybeans, wheat, sorghum, alfalfa, but we also have vegetable farms that we look at here, and you can see peppers and cucumbers and carrots being represented in the photograph. And we also have cattle ranches, and we could have other classes of livestock, such as goats and sheep, for example, that would fit that definition of being a farm business. But I think the key thing to take away is that it is a business with a profit motive. That then looks at, well, what does farming look like? Well, what are those? And again, we look to Code Section 2032 Cap A, and again, E4 as we saw previously, but these are the conduct or the activities of an agricultural enterprise or farm, and it's referred to as farming or ranching within the code. And then the italicized 3 bullets, as you can see, they're cultivating the soil or raising and harvesting agricultural or horticultural commodities, including raising, shearing, caring, training, and the management of animals. This is coming straight out of 2032 Cap A E4. Now, in the upper left of this particular slide, you see the photograph of an indoor type of lettuce operation, and this would still be farming, even though it's not outside in an acreage, if you will, but it is very much a controlled environment where we get salad, and in this case, it's leafy greens. And then in the lower left of this particular slide, we do see some calves representing livestock type of an agricultural enterprise, and the care, the raising, the training, and the management of these animals, that would be a farming activity. Also in that second bullet, you see that it's handling, drying, packing, grading, or storing on any farm, any agricultural or horticultural commodity in its unmanufactured or natural state. Having spent quite a bit of my career in North Carolina, I'm familiar with sweet potatoes. North Carolina raises approximately 50% of the sweet potatoes that are consumed in the United States. And those are harvested, and then they have to be cured, and that they still are, and that is part of a farming activity to get those sweet potatoes to a place where they would be stable for the market and not then quickly decompose. And then lastly there, you see planting, cultivating, caring for, or cutting of trees, or preparing trees for market. This is a very broad definition for farming. And as we move through some of the more specific safe harbors or definitions of being a farm or farmer, we will see that some of these definitions incorporate or exclude some of what we see here on this particular slide. So if we look at what a farm is, we look at what farming is, now we look at the people that are engaged in that. That would be farmers or ranchers as a broad term. And in IRS publication 225, which is the Farmer's Tax Guide, it defines a farmer or rancher as an individual who is in the business of farming. And that is if you cultivate, operate, or manage a farm for profit. Again, that profit motive is there. And you can do that either as an owner or as a tenant. So you could be cash renting some land, or you could be crop sharing some land. And that broadly is who a farmer is. Now, this definition also applies, as you can see in the lower left on this particular slide. It applies to partnerships, to corporations, to estates, and to trusts. So they can be having an equity interest in, or a management interest in, or a capital interest in the business of farming. And it could be that a farmer has passed away. There, in his or her estate documents, it transfers initially to his or her estate. The farm operation continues within the estate, and then once the estate is sorted out and then made available for the distribution of those assets, it then would go to the beneficiaries or to the heirs, for example. Similarly, with trusts are becoming maybe a little bit more useful, and they are maybe a little more frequently used depending on where the property is located. My experience has been if there is an area of urbanization, that sometimes the trust is a little easier to manage, particularly if we have one on-farm heir and we have an off-farm or several off-farm heirs. It could be just, but it's a tool. But they still could be, the trust could still be viewed as being the farmer because it is managing a business with a profit motive that is agricultural in context. And here we see the family walking through a wheat field, for example. So if we've looked broadly in trying to get a baseline as to what farming is, then we need to think of maybe a little bit about what farming is not. And there's a list here on this particular slide that it isn't custom harvesting as a service business. When I farmed nearly 40 some years ago in Western Kansas, we had custom harvesters that would come through and help us cut our wheat. And they would have 3 machines and we had 1 machine, so we had 4 total machines. We were doing the farming, they were doing the custom harvesting as a service business to our farm, and that was done so that we could get the crop in a timely manner and keep landlords happy. We also see that trucking of farm commodities to market as a service business, and for those that are in the Midwest, you might see grain trucks going to market, and if they're doing that, hauling it from the farm out of the bin to a terminal market, such as in Kansas City or maybe Omaha or Chicago, for example, that is a service business. And again, here illustrated in this particular photograph is the 3rd bullet, which is custom farming. Again, a service business. In this case, we're planting a crop, and you see the tractor with various tanks affixed to it, and then you see the planter, and then you see the service truck that's bringing also the chemicals or fertilizer out to fill those tanks up. This may be a service business that we're doing. Hey, I don't want to do it. It's the technology. I don't want to make that investment, but I'll hire somebody to come and do that. And then lastly, which we're seeing in some areas and in some sectors of production agriculture, we see that there is retention of the farm commodity, and then it goes through some type of processing to add value to those products. Just have 3 listed there, where we would take milk and turn it into cheese or ice cream or to yogurt, for example. We would have beef animals that, or sheep or goats that we would look at and process into cuts of meat. And then lastly there on that list is the wine. So that would be the farming of the grapes. That's a farming activity, but then taking those grapes and then crushing the grapes, extracting the juices, and then going through the processing and fermenting of those items, that grape juice, and turning it into an alcoholic product of wine that goes through a process. That is not, even though we're using as a stock or a source an agricultural commodity, once it goes into that processing, there is a point where it leaves the farming side and it goes into the processing side and then becomes a non-schedule or non-agricultural commodity. It becomes, as we have listed here, cheese, meat, or wine. And we need to kind of think through what it is that we're doing. And in this particular case, with this last bullet, you could actually have 2 different businesses. One is the farming business, where we're raising dairy cattle, we're milking the cows, we are then harvesting, collecting the milk, and then we take the milk and it goes to the cheese plant, and then at the cheese plant it's converted into cheese or to yogurt or into ice cream. But there is a point where that farming activity, the raising of the dairy cows and the milking and collecting of the milk, that's a farm activity, but then going over into the processing would be cheese. And that's going to be a non-farm business. Just a few examples here. We have an individual, Roger, operating a multi-enterprise farm, and he's got long-term gross receipts of about $750,000. And this is generally what we would think of. We could say Roger is a farmer. Contrasted to Maria, who has two special constructed greenhouses, and she's raising mushrooms. Maybe these are shiitake mushrooms, or maybe these are morels or whatever, but she's raising mushrooms in a controlled environment, and she generates, in this example, $25,000 of gross receipts, but earns $15,000 in net profits. In other words, she's spent $15,000 against the 25. Maria is still a farmer. Implicit here in this particular example is that Maria does have a profit motive, and therefore scale, as compared to Roger. Roger has $750,000 worth of gross farm income, as opposed to Maria's $25,000. It's not a factor. So we can look at what are we doing? What is the opportunity? What's being pursued? In Maria's case, she's raising mushrooms and she has a market for it, and she's generating net profits. She's still a farmer. We then have another individual, Amal, and raising tilapia, which is otherwise known as Nile perch. And these fish are harvested and they can go to market as live fish. They're shipped in special tanker trucks, or they could be fresh or they could be frozen. But for IRS purposes, Amal files Schedule F to report her income and her fish farming business, and just a little nuanced difference there. And then the last example just here is a tenant operation. Rick rents all of the land and he raises row crops. So he's got corn, soybeans, maybe some other beans, northern beans, etc. Rick is engaged in the business of farming, even though he doesn't own any land. Now, he may own his own equipment, and he may have gone through the economic exercise to realize that in his case, owning land may not be the best investment for him, and he can get a greater return on investment by owning the equipment and then being able to do it. But still, he's going to be a farmer, even though he is a tenant, and he uses Schedule F to report his income and his expenses from those farming activities. So I just mentioned in the case of Rick that we've got Schedule F, which you see here on the right-hand side of the screen, and IRS requires reporting of farm businesses to use Schedule F. Now, the sole proprietor farming business, they're going to use Schedule F, as we see here, profit or loss from farming, to report the income and the farming expenses. And we see there's part one, farm income, and we see the cash method. Not too many farmers use the accrual method. Matter of fact, in my experience, I've only worked with 3 farms that have used the accrual method. So it's, in my estimation, it's roughly about 2, maybe 1%. Most folks use the cash method. But you can see part one, lines 1 through 9, that's where we will look at the farm income coming in from various sources. And then part 2 is the farm expenses, again, using the for either cash or accrual method, looking at that. And you can see the listed items there that would be utilized for those various expenses that look agricultural. They are chemicals and fertilizers, etc., as you can see on this. Now, Schedule F can also be used by partnerships, corporations, trusts, and estates. They just would be looking at who the name of the proprietor is. I have used it for partnerships and corporations when I was doing tax returns professionally. And it's just very much easier to utilize that for the farming business, because you can see these items do look and seem to fit a lot better for the farming purpose than trying to come up with or utilizing the actual form. Now, 1120 and 1120S are the corporate forms. I usually have used those. I would use the Schedule F in that case as a supplemental and would make a notation on the tax return saying, see attached Schedule F for that. And I've never personally had any problem. But broadly, what we're going to look at here and what I want to point out is that we're going to look at Schedule F. We're going to have instances where we're going to focus on line 9. We're also going to focus potentially on line 34 as a cumulative net farm income for the purposes of meeting some of these safe harbors. And we'll get to those in just a minute. So we're going to transition. Hopefully, I've kind of set what the baseline is for who a farmer is, what farming is, and what a farm is. But when we read the Internal Revenue Code, as you can see on this particular slide, the terms farm, farmer, and the business of farming are generally going to be consistent throughout the various tax provisions in the Internal Revenue Code. Now, unfortunately, there is not one all-inclusive definition that continually gets referenced. We've got different definitions. We've got different safe harbors, if you will. And what is really important is for tax practitioners as well as farmers to understand which definition, which safe harbor is going to be utilized for which purpose. So the usage of the terms could be interpreted in different ways for the purposes of applying different income tax provisions. And then there's this next bullet is that there are several definitions that hinge on the term gross income from farming. And as such, this is what's creating the safe harbor for qualifying taxpayers. Unfortunately, sometimes when we look at gross income, it's referenced to Form 1040. And then further, it's referenced to adjusted gross income, which then leads to, oh, what we need to do is look at net income. Other places, it is gross income, so we don't look to 1040 per se. We're going to look to the supporting business form, Schedule F, which I just illustrated and showed just a moment ago. And then we're going to look at generally line 9, and then we need to see what those definitions are. And what we're going to look at next is some of the more common examples that illustrate who is a farmer and for which purpose, and look at the definition and see that it is going to be different. And the first bullet says, we wish we had an all-inclusive definition, but we don't. And so we have to really, as I frequently say, we have to peel the onion to get to the core of the issue and see exactly what it is that we're looking at. There are some unique definitions, or again, safe harbors that are relative for farmers and also for the filing of tax returns. There are different income thresholds that need to be considered and understood. Those are for the estimated tax penalty, for soil and water conservation expense deductions, qualified conservation donations, if that's part of the land ethic. Then there are places where income thresholds aren't considered at all, such as income averaging and the deduction of fertilizer. And then there are other definitions that are very specific that we need to look at, and we'll hit some of those in just the next few minutes. So if we are self-employed, our income goes up, down. We broadly are a pay-as-you-go type of system relative to taxes, and there is the requirement to make estimated tax payments on a quarterly basis. However, there is an exemption or an exception if you're a farmer. And in order for you to qualify, that has the definition of having 66 2/3 of your gross income coming from farming. And there is the Internal Revenue Code section 6654I2 that provides that sourcing. Now, the source of farm income for this purpose. Okay, so we're talking about, are you falling into, as a farmer, are you falling into the exception for the estimated tax penalty? The sources of that, and this is just a snapshot over on the right-hand side of this particular slide, looking at what are the gross income. So it's gross farm income from Schedule F, and that's attached to Form 1040. It could be gross farm rental income if we're on a crop share basis from 4835. It could be gross farm income from Schedule E, parts 2 and 3, if we are a partner or if we are a shareholder in a sub-S corporation. That's where we report those two when that information flows through from the partnership or the sub-S corporation via a K1, saying this is the taxpayer's pro rata share of farm income, and we would have that. We also would look at the gains from the sale of livestock used for draft, breeding, sport, or dairy purposes, as reported on Form 4797. Generally, we're looking there at Part 1 of 4797. For those animals, they are going to be the adults, and they would, if they're raised, they're going to be on Part 1. If they had been purchased and then they were depreciated, they would be reported on Part 3 of 4797, and the net gain then would flow through over to Part 2 of 4797. And then lastly there, if we have gains from the sale of depreciable farm equipment reported on 4797, so that would be our tractors and those kind of things that either would be traded, and that's treated now as a deemed sale, or if we actually sell the piece of equipment. Those are going to be the sources of gross income from farming for the purpose of meeting the 66 2/3 exception for this individual. So here again is a line 9. I'm just trying to keep this a little bit simple. In this example here, line 9 is the total, obviously, of lines 1 through line 8. And in this example, we've got Betsy, who's a farmer. She grows soybeans, corn, and she has some cattle. But what we need to think about is what's her gross income in this particular case. And I'm only illustrating Schedule F, but if she's got some cull cows, she would look at Part 1 of Form 4797 as well. But you see here, line 9 in this particular case, $329,200. If that is 2/3 or more of her gross income, then she has a filing date of March 1. She would pay all of her tax, both income tax and Social Security tax. And if she's in a state that also collects state income tax, then she would have a March 1 filing date. She would not need to pay estimated tax payments. But if she decides to, she could make an estimated tax payment. She could make that single tax estimate by January 15 of the year closing. So it would be January 15 of 2025 for the 2024 production and tax year. So the key here, the key takeaway of this particular one is looking at what's her gross farm income. In this case, line 9, notice we're not looking at net, we're looking at gross farm income, line 9, $329,200. And is that 2/3 or more from all the other sources that she might have on her return? Another one we look at, and this is for soil and water conservation expenses that individuals have. This is going to be limited to 25% of gross farm income. And again, generally, it's going to be line 9 of Schedule F, and the citation there is under Code Section 175, subparagraph B. And if we are active material farmers filing a Schedule F, and there you see it's 175C2, or if we are crop share landlords, there's a comma in that definition. Again, the same citation, Code Section 175C2 again. And here's a special one for the purpose of this deduction, of being able to take soil and water conservation expenses. We are treated, if we are a crop share landlord, as being in the trade or business of farming and being able to deduct it, subject to the 25% limitation. But if we're cash rent, that will not be allowed. And generally, these soil and water conservation expenses are going to be added to the basis of land unless we make a planning decision. We're going to do some soil and water conservation. Let's convert to a crop share for this year and then be able to deduct that. But anyway, again, our friend Betsy in the following slide, she's got the $329,000, as you can see here again. And so her conservation expenses for this purpose is going to be limited to 25% of line 9. And Betsy's case, when we do that, is going to be $82,300. So if she spent less than $82,300, she's going to be able to fully deduct the soil and water conservation on part 2 that we saw earlier when we had the full page 1 of Schedule F up. But this is a limitation, or the safe harbor that is afforded. So number 1 has to be in the trade or business of farming. And if we are either as an active and material participant, which we are illustrating with Betsy here, or we could be a crop share and filing IRS Form 4835 for this particular purpose, still the 25% limitation is in effect. What happens if Betsy spent $100,000 in soil and water conservation? In this particular year, she'd be able to deduct $82,300. She'd have to carry over the other part, the $17,700. That would carry over to 2025 in this particular situation, and then still be subject to the 25% rule in 2025. But we would be able to consume it. We would consume that first, and then we would look at, did she have any other soil and water conservation expenses in 2025? Yes or no. Still, we could add those two together. If they are below the 25%, then we go ahead and expense it in 2025. So qualifying as a farmer in this particular case, she would get, as we see here, a benefit of $82,300. That's going to be the limitation. Another deduction or another opportunity for farmers and their families is maybe to preserve farm or open land. If that's part of their land ethic, if that's part of the family's value system, if that's whole. And in the 2006 Pension Protection Act is cited there, and you get the reference, there was an amendment that allowed farmers and ranchers to deduct the value of these charitable contributions to the extent they didn't exceed 100% of their contribution base, which is generally going to be their adjusted gross income. So here's a place where previously we were looking at their, in Betsy's case, gross farm income. Here we're looking at AGI, adjusted gross income. So we're going to have to change to a net income consideration. And now if we're not a farmer, then all other taxpayers, as you can see there, are limited to 50%. So for this purpose, then, a qualifying farmer is one whose gross income from farming and ranching is greater than 50% of gross income from all sources for the year of contribution. So we saw that Betsy had a 2/3 limitation for estimated tax. Here's a different limitation. And this second one is looking at, they have to have 50% of gross income from all sources, but we have the reference to their adjusted gross income. And so we want to understand what that is. And lastly, on this slide and the lower one, is that for this purpose, for the purpose of making a conservation contribution, farming is defined with reference to Code Section 2032A, which we saw earlier. Okay, and I use that broadly as a definition of what farming is, but this includes timber. So for this purpose, individuals who have timber, and when I worked in North Carolina, again, timber was a very large part of that agricultural setting. So here's an example. We've got an individual that has gross income, and notice that this is tax return income. So we're looking at what's on the tax return because we're looking at AGI, okay, adjusted gross income, and we've got total gross income coming in, and you can see there I've got wages of 30,000. We have some interest income of 1,000. We have farm income, and note the parenthetical there is net $65,000. So that's going to be coming from line 34 on Schedule F. Then I've got the sale of some non-farm equipment. So this is not part of farm income, 55,000. And then we have the sale of timber, $70,000. So then we look at the sources of gross income, and then you see all the way over on the right-hand side, gross income from farming is going to be 65,000 and 70,000. So we need to look at, well, what's our percentage? So our third bullet down, gross farm income, 135. We divide $135,000 by $221,000. That gives us 61.11%. So greater than 50%, they qualify as a farmer. They are able to offset 100% of their adjusted gross income with the value of this particular conservation contribution. So that fourth bullet there, they do qualify, as you can see there, for the conservation contribution. That's a yes. But notice that they do not qualify for the estimated tax rules because it's less than 2/3 of the farm income in this particular case. So they would have been required to have made estimated tax payments. So the takeaway here in this example, as compared to the previous example, is that we have a definition, but we're using different values to create what gross income is. And we're looking at different percentages. We have a 50% threshold, which we have met for the purposes of a conservation contribution, but we have not met the 66 2/3 percentage for estimated tax. So it's very important for individuals to understand and know what those limitations and what those purposes are going to be for. So another one here is income averaging. This is for farm income averaging, and farmers and fishermen are two business categories, two different sets of taxpayers that can qualify potentially to average their income and basically be able to reduce their income tax. Interestingly, for farm income averaging, there is not an income threshold that defines a farmer. However, it's going to be electable farm income that's going to be eligible for that. And under these rules, the elected farm income is going to be carried back equally to the 3 prior years from the election year. So we have the election year, and then we have what we call the base years, and those are the 3 prior years, and and if the unused base years are in lower income tax brackets, then it makes sense, economic sense and tax sense, to be able to go back and then to utilize the elected amount back into those 3 base years. Electable farm income is going to be net Schedule F. Notice it's net. The gains from the sale of breeding, dairy, draft, livestock, and equipment sales. But for this purpose, timber and land sale gains are excluded because timber and land sale gains are generally going to be have capital gain tax rates applied, which are going to be preferential. So notice, and here's a change, notice for income averaging, timber is not farm income, but for the purpose of a charitable contribution, timber was. So you can see how public policy was crafted so that an encouragement to preserve open space, to preserve green space, timber was farm income, to be an encouragement to get at the 100% of AGI that could be offset for the charitable contribution. But for income averaging purposes, timber is not. It's excluded as illustrated here in the highlighted area. And then additionally, lastly, if the taxpayer is a shareholder in a farming S corporation, then in that case, the wages can be attributed to the farm business as farming income. So the layers get very, very complicated as we move into the next example. So here's the example. Again, we're looking at total tax return income. You see salary, and this salary is not from farm salary. This happens to be the spouse's salary, and it has a job in town. They have some interest and dividend income, $1,500. They have a capital loss of $3,000, as denoted there, being red. Net farm income of $150,000. Gain on breeding animals of $5,000, and then gain on the sale of equipment, $2,500. Now, we sort through that gross income. Notice that the capital loss isn't added in gross farm income. Thus, we have $199,000 is the gross income value there. But the electable farm income is going to be $150,000. That's coming from net farm income on Schedule F. That would be line 34. Notice, and again, I've got it highlighted on this particular slide, that we're getting capital gain treatment on the breeding animals because those are being treated as Code Section 1231 assets. Thus, the $5,000 is going to have that $3,000 capital loss offset. So that's why we only have $2,000 over there in that far right-hand column. And then we have the gain on the sale of equipment, $2,500. So then when you look at the total allowable, electable farm income, $154,500. That is what's going to be moved out if we just decide to do that this particular year. As an example, we move that out. The maximum that you would go into the 3 base years is going to be $51,500 into each one of those. That's just 154,500 divided by 3. So that's how that works. I just am using this as an illustration. Obviously, we might say, hey, we don't want to do all of that because we want to be able to use some of the 10 and the 12% brackets available in the current year. So we might look at a lower electable income. Just in this example, I'm illustrating the maximum amount that would be able to be averaged back into the previous 3 years. And again, I think the takeaway is, in my example, if we have a capital loss, 1, we don't include it in gross income, and 2, it does offset the gain on the breeding animals, as you can see in the calculations, as well as the notation in the highlighted form. The next one that we look at is fertilizer and soil amendments. Under Code Section 180, which there is a method to deduct fertilizer and soil amendments. Generally, it is an election to do that and be able to deduct that in the year that gets applied. When one is reading Code Section 180, it looks like that and is to be understood that we should capitalize those items. So it says there, taxpayers who are engaged, again, in the business of farming, which is going to be farmers with the parenthetical, may elect to deduct what is generally to be capitalized. And the reason that it would be capitalized is that fertilizer and soil amendments generally have a useful life of more than 1 year. Now, the land to which the fertilizer and these soil amendments are applied have to be used in farming. So that could be corn ground, soybean ground, vegetables. It could also be improved pasture. So it has to be in the prior year or in the current year if it's done by the landowner or a tenant. And this provides some flexibility if there is a change in ownership or a change in operation of the land. We could look back and say, oh, it was used in farming in the prior year by such and such. We're able to take the deduction. And the election is actually very simply made by taking the deduction on the return. And here is just an illustration of that. We've got Farmer John. He deducts $15,000 of fertilizer by making the entry. As you can see here on line 17, this is just a screenshot from Schedule F Part 2, where we see fertilizers in line, $15,000. And that is simply how that election is made. So if this has been a formula, or not a formula, but if this has been a practice by an individual over time, then the reality is there's an annual election that's being made, and not to amortize this. And there may need to be some kind of communication. Hey, does this make sense for me to do that? And most often it probably is that, but again, this has to be an individual. Now, what about if a farmer can make this election? What about the landlord? Well, the landlord may not be, if it's a cash situation, and depending on what the lease arrangement is, let's say that the landlord is responsible for applying lime, making sure that the soil's pH is within a range, and that's just part of the cash rental arrangement. Then because it's cash rent, that's not farming, that is a return to an investment. He's going to have to amortize that lime payment over a period of time, 3 to 4 years, maybe 5 years, depending on where and how long this lime would be available. And if they're making lime applications once every 3 to 4 years, then it would make sense that 3 to 4 years would be the amortized life. But the illustration here, or the fine point, is that the landlord applying the lime is not in the business of farming, but needs to amortize that. But generally, those might be done by the farmer. Here's another one where farmers are exempt from inventories or keeping track of inventories. Here's Treasury Regulation 1.471-6, and you can see it quoted there. Further, a farmer making his return on an inventory method instead of the cash receipts and disbursement, it's optional with the taxpayer, which these methods of accounting are used, etc. And also under Code Section 448, there has been a recent change for small businesses. It's known as the small business exception. With gross receipts less than 31 million, that is the inflation adjusted amount for 2025. And here the gross receipts is just that. What's the total gross coming in to the business? And if it was 31 million, then they can use cash accounting. They don't need to take inventory and then calculate that essentially on the accrual method is what we're looking at here. Another one, and this is where we see individuals that might have cancellation of debt, and they have the rule for the solvent farmer that gets the exception for cancellation of debt income. And here under Code Section 108A1 Cap C, qualifying taxpayers who are farmers may exclude cancellation of debt income, or CODI, from tax calculations if the debt was qualifying farm indebtedness. And qualifying farm indebtedness is defined to be the amount of indebtedness incurred directly in connection with the trade or business of farming. So we go back to some of those original definitions, and we have to see that Are you in the trade or business? Has it risen to that level in borrowing that money? Additionally, that second one and highlighted, 50% or more of the aggregated gross receipts. So this is the broad line 9 from Schedule F from the trade or business of farming for the last 3 tax years immediately preceding the tax year when the indebtedness was discharged. You have to look at that. And then secondly, the discharge has to be made by a qualifying person. Basically, that's, are they in the business of lending money, such as a bank, or it could be also USDA in some of its lending activities. But the key here is you have a 50% or more of aggregated gross receipts, and that is the line 9 that I referenced earlier in the Betsy example that we have. That's gross farm from income. There's another one that farmers have the opportunity to pay their labor from non-cash sources such as commodities. And there is an exception of FICA taxes on non-cash wages. So the payment for labor in that is exempt from FICA. And there's the citation that you can see there in the middle of the screen, Code Section 3121A8 Cap A. And this is for remuneration paid in any medium other than cash for agricultural labor. And this, I'm making a note here, and it's in bold, that the reference in this code section is for agricultural labor. Thus, it's presumed by the law that a farmer is paying for that labor. And so in the example that's at the bottom of this particular slide, we see that Rosa pays her hired labor $20,000 a year in cash. Additionally, she pays them about $10,000 in commodity wages. So FICA is going to be paid on the $20,000 per the usual rules. And then the commodity wages are going to be exempt from FICA. And so in this case, neither party is going to be subject to any of the 7.65 withholdings relative to that. Farming C corporations, this is one, and this may get into the weeds a little bit, but similar to when we looked at the discussion of inventories, Code Section 448B1 allows farming corporations to use the cash method of accounting. And you can see the definition that is in there, that as a general rule, they have to, but the exception, and this is under paragraph B, farming business, paragraphs 1 and 2 of the subsection A above are not going to apply to any farming business. So that is a benefit to them. As we're coming to the end of this, we're looking at excise tax on gasoline. Farmers and ranchers, they do have motorized equipment that uses gasoline, but they may use it in non-highway use, such as four-wheelers, tractors, pickups, aircraft. And Code Section 6420, as you can see cited in this particular slide, allows for a tax credit, which is calculated by multiplying the number of gallons of gas used and then the federal fuel excise tax, which happens to be 83 cents per gallon, or excuse me, 18.3 cents per gallon. So the definitions for farm and farming purposes are very similar to those that we have discussed earlier. And if you want more detail, then look at Code Section 6420C for more detail. Now, the one thing to take away from the fuel excise tax, and I've used this just about every year that I've done a farm tax return, is that the benefit is a two-step, 2 tax year exercise. And so here is step 1. In this example, Jim operates a ranch, and in 2024, he consumed 1,000 gallons of gasoline on the ranch, and it was documented non-highway use. So Jim's tax professional calculates his federal excise tax credit to be $183. So that's just 1,000 gallons times the 0.183. And this was a 2024 credit on his 2024 tax return, but it was calculated in 2025 when we were preparing that tax return. And it starts out on Schedule 3, line 12, which you see there. There's also the supplemental form, which I'm not illustrating, which is Form 4136, where we get the calculation of this tax credit. Essentially, it's the 1,000 times 0.183 gets you the $183. Then from Schedule 3, it flows to the payments, and it goes on to line 25C of Form 1040, as you can see there. And so it's a credit against the tax. So here's where he gets the income tax benefit of that. But because he gets the income tax benefit, the tax benefit rule applies. And so in the subsequent year, which would be 2025, he has step 2 applied. And this is going to be where he has to report that income, that credit. And so it's other income. This is line 8 of Schedule F. And you see there in the line instructions, other income including federal and state gasoline or other fuel tax credit or refund. And there's that $183. So he gets the benefit of it against tax in 2024, but then he ends up having to report that as income. Now, remember, it's at the margin. So if next year in 2025, he's in the 12% tax bracket, then he's only going to pay tax at 12% of 183. It's still better in the long run. He's economically much better down the road. So as we're wrapping up, and just about on time with this, the summary here is that an all-inclusive definition of farm, farmer, farming is not found in the Internal Revenue Code. There are consistent definitions across the code, as I hope that I have illustrated during this webinar. Farmers and ranchers need to be aware of the nuanced definitions for specific tax benefits that accrue based to those specific fact patterns. Likewise, their tax professionals should also be aware of these definitions and the tax benefits which may be of help to the farm and ranch clients. Which leads us to this very familiar picture that Denny Overton, which is the mother of these two twins, Matt and Chris, took these farmers, and you might remember seeing this particular poster and have you been farming long? There are a few references. One is ruraltax.org, looking at some of those topics, farm and farming and who is a farmer. There's an article to that. There's also the IRS Farmer's Tax Guide. I provide the link here for that. And should there be any follow-up questions to this particular webinar, info@ruraltax.org will get any questions sent to my attention down the road. So that wraps us up. Just wondering, see, we have a few participants on. Were there any questions that they might have? If not, you might want to put them in the chat. If not, thank you for your attention today.
You've got one here. Got a cattle goat farm, has houses located on the property. Considering a vacation rental by owner for the houses on the farm to supplement the farm income. Would the rentals be considered separate business, or could it be run under the farm for farm income and expense purposes?
That's a really good question, and I'm seeing quite a bit of that. The answer to that is they are separate businesses. It would be a Schedule C business where the depreciation and any of those expenses and the income would be generated to that Schedule C, which is going to be a non-farm business. And then the farm business, as we've looked at and explored today, that would be on Schedule F, assuming sole proprietorships. There might be an LLC formed for both or either one. It would be Schedule C because generally the vacation rentals or the Airbnbs, they're going to be less than 30 days, and IRS requires that be filed on a Schedule C and not a Schedule E.
All right. So at this point, see nothing else popping up for questions, and you did cover the Schedule C and E issue. So Appreciate that. Still looking for additional questions. Nothing's coming in. I believe you've done a great job, Guido.
All right. Well, thank you all for that. And I'm going to stop sharing my slides.